Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Infrastructure bill updates. The controversial crypto tax provision remains unchanged as the bill approaches its final stage of approval. Why this could happen much sooner than expected. Cardano smart contracts confirmed. IOHK has confirmed the date for Cardano's smart contract hard fork. What to expect when the rubber hits the road. On the cutting edge of crypto tech, Solana launches its Wormhole bridge, Secret Network begins testing its Monero bridge, and Polygon acquires Hermes Network. How these developments could be a game changer for crypto. Playing chicken with hundreds of millions. The biggest hack in DeFi results in returned funds, raising questions about what really went down and why. My hot take. Big bets on a Bitcoin ETF. After comments by SEC Chairman Gary Gensler, almost half a dozen firms file for a new type of Bitcoin ETF that might just get approved. When could they get the green light? Institutions bullish on Bitcoin. The world's biggest banks set their sights on crypto custody, and big investors begin accumulating Grayscale's GBTC. How long will their bullish behavior last? And a closer look at the bull run on the horizon in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Early last week, US senators approved the controversial infrastructure bill without clarifying the language around crypto tax reporting. As I mentioned in last week's crypto market forecast, the wording of the crypto tax provision is problematic because it fails to define what a cryptocurrency broker is. Given that brokers would need to collect KYC from users for tax purposes, this could potentially require cryptocurrency miners, wallet developers, and even protocol developers to collect KYC for all their users. Now, obviously, this is unfeasible, and thankfully, an unnamed official at the US Department of the Treasury later confirmed that the broker definition does not include miners, validators, or developers. While this is certainly reassuring, government officials have not done the best job of keeping their word over the last year and a half, to say the least, so we won't know how the rule is really applied until the infrastructure bill is passed. On that note, the infrastructure bill was set to be officially passed sometime in late September, after US politicians in the House returned from their 6-week recess. However, there is now chatter that House politicians could convene next week to pass the infrastructure bill before returning to their sun loungers. The reason why this is concerning is because SEC Chair Gary Gensler has been pressuring House politicians to give the SEC the authority and resources required to clamp down on cryptocurrency. While it's unlikely that the House will address the SEC's powers next week, it is very much within the realms of possibility. If and when this does happen, it could crash the crypto market for the reasons I detailed in my recent video about the SEC's views on cryptocurrency. Now, luckily, there is no shortage of bullish developments for cryptocurrency on the horizon, and the talk of the town last week was Cardano's smart contract update. As I explained in my most recent video about Cardano, its smart contract rollout, dubbed Alonzo, consists of various color-coded phases. The most important of these is Alonzo Purple, which actually began the day after my Cardano video hit the tube. If you're wondering why ADA rallied so hard last week, that's because Cardano founder Charles Hoskinson noted that dates would be released for the completion of Cardano's smart contract functionality in the coming days. These dates were detailed by IOHK last Friday as part of its monthly development update, and the official date for Cardano's smart contract hard fork and launch is Monday, September the 12th. Now, the funny thing is that September the 12th is not a Monday, but a Sunday. Monday is September the 13th, and it's not entirely clear which of the two dates it will be. Moreover, it's important to keep in mind that Cardano's smart contract hard fork is dependent on the success of the testnet smart contract hard fork, which will occur on September 1st. If Charles Hoskinson's comments are anything to go by, the smart contract rollout is going very smoothly, so we are unlikely to see any delays. In terms of what we will see on September 12th or 13th, given how much ADA rallied on the mere announcement of the dates, it's basically a given that it's going to go ballistic around that time. A realistic price expectation is somewhere in the $4 to $6 range, and because I personally hold ADA, I'm a bit biased towards the latter. Speaking of cryptocurrencies in my portfolio, Solana finally launched the mainnet of its Wormhole cross-chain bridge last week. Wormhole supports both fungible and non-fungible tokens minted on Ethereum, the Binance Smart Chain, and even Terra. Thanks to Wormhole's unique architecture, it will be possible to transfer assets between these blockchains in a seamless manner, offering a degree of interoperability comparable to that of Cosmos. That said, the Wormhole bridge is undergoing an upgrade at the time of shooting, and as per the warning message, it's not recommended that you use it at this time. Another big bridge development last week was the testnet launch of Secret Network's Monero bridge. For those unfamiliar, Secret Network is a cryptocurrency project that makes it possible to create privacy-preserving smart contracts with privacy-preserving tokens called secret tokens or S tokens. Secret Network has been working hard on interoperability, and its Monero bridge will be the fourth it has built once it's complete. The reason why Secret Network's Monero bridge is so significant is because XMR cannot currently be used in any DeFi protocols. This is due to the transparent nature of DeFi smart contracts on other blockchains like Ethereum, which make it impossible to have a wrapped XMR token that's truly private. On Secret Network, however, this sort of privacy exists by default. By building a bridge to Monero, XMR tokens can be used in Secret's DeFi protocols, creating new use cases for XMR. The XMR being bridged over is kept in a multi-signature Monero wallet, which could serve as an attack vector, but I reckon this is something that will be stress-tested during the testnet phase. Now, you can learn more about Secret Network by watching my video about it using the link in the top right. The last big bullish development that caught my eye last week was Polygon's acquisition of another crypto project called Hermes Network for a staggering $250 million. Polygon is, of course, Ethereum's leading Layer 2 scaling solution, and it leverages a technology called Plasma, which creates a copy of the Ethereum blockchain called a child chain, which runs parallel to the main chain and relies on it for security. Polygon's acquisition of Hermes is not that surprising, given that Polygon aims to be Ethereum's Internet of Blockchains by providing a whole host of Layer 2 scaling solutions and not just those involving Plasma. Hermes Network is also a Layer 2 scaling solution for Ethereum, and it uses a different technology called ZK rollups, which essentially involves bundling multiple Ethereum transactions together and submitting them as one on the blockchain. Rollups is the same technology used by other popular Ethereum scaling solutions such as Optimism, which leveraged optimistic rollups. Now, at first, I believed that Optimism would be the winner of the Layer 2 race. As I mentioned in my video about the top crypto picks for the rest of 2021, I was dead wrong about Polygon, and I'm definitely happy I picked up the Matic token when I made that video. Polygon's acquisition of Hermes means that it will soon offer ZK rollup solutions for Ethereum of its own, and this could cement Polygon as the undisputed leader of Ethereum Layer 2s. My only concern here is that Polygon purchased Hermes using $250 million worth of Matic, which could add additional sell pressure for the token and have a negative effect on its price. On the flip side, Matic has no shortage of demand coming from users on the Polygon Plasma sidechain, and the introduction of a roll-up sidechain will only add to the demand for Matic in the long run. You can find my most recent video about Polygon by using that link up there in the top right. Polygon's acquisition of Hermes couldn't have come at a better time, as it was one of the 3 chains negatively affected by the now infamous hack of the Poly network's interoperability protocol. Over $600 million were stolen by an anonymous hacker, mostly from Ethereum and the Binance Smart Chain. After the news was shared on Twitter, multiple exchanges, including OKX and Binance, announced they were on the lookout for any funds coming in from the hackers' addresses. Tether even froze $32 million USDT, which was siphoned out by the hacker, once again revealing just how much power centralized stablecoin issuers have over their tokens. Shortly afterwards, the hacker began returning the stolen funds and even hosted an AMA by embedding messages in transactions on the Ethereum blockchain. In this AMA, the hacker explained that they hacked Poly Network for fun and that they had planned to return the funds from the outset. It seems they just wanted to teach the crypto community a lesson about security in DeFi. The hackers' on-chain activity suggests something else, however, as they had tried to deposit some of the stolen cryptocurrency into Tornado Cash, a protocol which mixes funds on Ethereum to break the connection between sender and recipient. Not only that, but they were actively trying to swap the assets they'd stolen for stablecoins, only to be notified by an anonymous user that their wallet addresses had been blacklisted by Tether. The anonymous user who warned the hacker of this received a 40 grand tip from the hacker, and this was just one of many gestures of good faith that the hacker gave to anyone guiding them on their attempted exit strategy. Some users even went as far as asking the hacker to airdrop all the crypto they'd stolen. Now, there's so much more to this story that I can't get into here, but it's clear to me that the hacker's decision to return the stolen funds was not something done out of good faith. I think they saw just how centralized stablecoins and DeFi protocols are and realized that there was no getting away with that amount of money. The centralization of DeFi protocols is a very real threat to crypto, since they make them susceptible to the sort of regulatory clampdowns that seem to be coming this fall. More on that up there. Before the regulators come for crypto, it's likely we will see a Bitcoin ETF approved in the United States, possibly even an Ethereum ETF. This is because SEC Chairman Gary Gensler recently noted that he was open to approving cryptocurrency ETFs backed by CME futures contracts. Not surprisingly, nearly half a dozen firms have filed for futures-backed Bitcoin ETFs since Gary's comments. As I mentioned in my video about cryptocurrency ETFs, the SEC has 45 days to respond to these applications. Though it's not clear whether this means regular days or business days, this timeline puts us somewhere in mid to late September. Some of you may know that the introduction of Bitcoin futures on the CME exchange in 2017 marked the top for Bitcoin, and it's possible we'll see a similar top signal with a Bitcoin ETF. The reason why I think Ethereum could see an ETF as well is because the CME exchange introduced Ethereum futures earlier this year. In theory, this means that Gary would also be open to approving an Ethereum ETF too. Now, futures-backed ETFs are of course very different from crypto-backed ETFs, whose filings we've seen in the news every other week since the start of the year. Crypto-backed ETFs would have a more profound effect on the price of BTC and ETH because they require the issuer of the ETF to actually purchase BTC or ETH behind the scenes and hold it in custody. This is not the case for futures-backed ETFs, which basically involve investing in IOUs. Now, I'll just quickly point out that the SEC issued a warning about the risks of investing in Bitcoin futures in May this year, which makes me wonder why it's so open to approving a futures-backed ETF. Anyways, Gary isn't keen on crypto-backed ETFs because he wants the SEC to set additional regulations around crypto custodians. From where I'm standing, it looks like Gary is buying time for his buddies back at Goldman Sachs, and here's why. A report released last week by Blockdata revealed that more than 50% of the world's 100 largest banks are investing in cryptocurrency and blockchain companies. Lo and behold, Goldman Sachs is among the banks investing the most into crypto tech, and its point of focus is coincidentally crypto custody. US banks have been investing heavily into crypto custody since US regulators announced that federally chartered banks could custody crypto in June last year. As I've mentioned a few times before, banks aren't very happy about the billions of dollars going off their balance sheets onto exchanges and into DeFi protocols. This was also noted by the Blockdata report, which highlighted the fact that Coinbase's stock valuation is higher than Goldman Sachs's, even though its company is a fraction of the size. Naturally, big banks don't want crypto custodians like Coinbase and Gemini to be holding all the BTC behind a US Bitcoin ETF the way they are with the crypto-backed ETFs trading in Canada and elsewhere. Methinks that a crypto-backed ETF will come around once the big banks have finished implementing their custody solutions, which will likely take another year or two. Maybe the SEC will even decree that banks are the only ones who can custody cryptocurrencies backing crypto ETFs, but that's just my personal conspiracy theory. In the meantime, institutional investors are finding other ways of getting exposure to cryptocurrency, and some of the most popular investment vehicles are Grayscale's crypto trusts. Recent filings with the SEC reveal that 4 asset managers in the United States are investing heavily into Grayscale's GBTC trust, which holds over $30 billion in BTC. This news follows that Intel has taken a sizable position in Coinbase stock. Now, this all seems to be a reflection of the bullish sentiment circulating on Wall Street, which is apparently the highest it's been in over 2 decades. The fact that stocks continue to hit all-time highs suggests that crypto will quickly follow, and that's exactly what I'm seeing on the charts. BTC hit a super important price point last week, and that's the 200-day moving average. Crossing that ceiling from below is often considered to be a sign that there are more green days to come. As you can see, we went above and below the 200-day MA a few times, and I suspect that this was the institutions shaking out anyone going long above the 200 or short beneath the 200. Now, I've seen a lot of chatter about the ascending wedge BTC is forming on the daily, as well as the bearish divergence which can be seen on the daily RSI and trading volume. Many traders are taking this as a sign that BTC is about to break to the downside, but I'm not so convinced. Besides the fact that all indicators remain bullish on the weekly time frame, there are still many bullish developments on the horizon for Bitcoin and crypto in general, including the ETF I mentioned earlier. It would not surprise me at all if we saw this ascending wedge break to the downside as predicted, only to see a sudden reversal on the news that a Bitcoin ETF has been approved or something similar. In any case, the low balance of BTC on exchanges means there's a lot of volatility coming up over the next few weeks, so don't get spooked by 5 or even 10% moves on the daily. When in doubt, zoom out. Turning to altcoins, this week's winners are IOTEX, Zinfin Network, XRP, Ravane, and Ravencoin. To say that the IOTEX token has gone parabolic is an understatement. What you're looking at is a 4x gain over a 1-week period. IOTEX is rallying on the news of a Coinbase listing, which came shortly after its integrations with the Binance Smart Chain and Polygon. IOTEX actually looks like it's primed for another pump on the daily chart, which is typical of cryptocurrencies shortly after they list on Coinbase. IOTEX also has a low dollar value, which is likely to lure in retail investors who don't know what a market cap is. I know I say this every time, but I'll say it again. Market cap is what ultimately determines the potential of a token, not its price tag. Zinfin's XDC coin also saw a similarly parabolic price pump last week, which also managed to push it past its previous all-time highs. It looks like XDC's rally is being driven by its partnership with a project called LedgerMail, which is apparently the first decentralized email solution built on the Zinfin network. Though I'm still not too keen on XDC's exchange support, trading volume, and institutional orientation, it looks like Zinfin Network is doing something right. Next up is XRP, which is slowly creeping up to its local top of $1.80. This is because Ripple gained ground against the SEC in court by getting access to Binance's internal records, something which could prove to be a game changer for crypto regulations in general, though not necessarily in a good way. Ripple also recently partnered with one of the top remittance firms in South Korea, which will use RippleNet to send payments to and from Thailand. XRP seems to be struggling around the $1.30 mark, which is a historic zone of support, now resistance, since we're below it. All indicators remain bullish though, and I could see XRP heading to the $1.50 range this week if Bitcoin doesn't dump. Ravane is another crypto that's made the weekly winners list before, and some of you may recall that it's not one I'm very fond of. The price chart kind of says it all. The recent pump doesn't even register. It looks like Rev is moving because of some sort of competition that gives Ravane community members free cryptocurrency for completing specific tasks up until early September. Unfortunately, the REV token has very limited exchange support and low trading volume, which is why I would be very cautious about this crypto. It's a similar story for Ravencoin, whose price seems as though it could be manipulated by the whales who hold most of RVN's supply. Oddly enough, it looks like Ravencoin is one of the most profitable cryptocurrencies to mine at the moment, and this hype might be the justification behind RVN's price pump. I have no idea who's buying, though. Well, that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie, or both. Links to all these resources are in the description. Thank you so much for watching, and I'll see you all in next week's episode.